Hello, class. So today we want to look at retirement plans. If you're taking the PHR exam, SPHR exam, you most likely will see questions that have to do with pension plans, retirement plans, deferred compensation, which just means compensation that you're going to get in the future. And that's what we're looking at today, retirement plans. So I'm just going to go really slowly so that everyone can understand. Um, when it comes to private retirement plans, just what you see right here, there is a law that governs that, and it's a federal law. So if you're taking the PHR exam, SPHR exam, and even you might find some questions on ERISA or defined benefit plans, defined contribution plans, when you're taking the SHRM CP, SHRM SCP. And so it's good to know about, this retirement plans. There is a law, a federal law that governs them. And if you're taking any of this HR certification exams, you're going to be tested mainly on federal law. So you are required to know, some details about this law when it comes to retirement plans. And that's the ERISA. It's the Employee Retirement Income Security Act of 1974. Like I said previously, you do not have to remember the dates, but ERISA, basically, this is the main federal law that governs private retirement plans and the Internal Revenue Code. So as we go, you would see that ERISA is governed by mainly three bodies, enforced by mainly three bodies: the DOL's Employee Benefit Security Administration, just right here, Treasury Department Internal Revenue Service, the IRS, and the PBGC, the Pension Benefit Guaranty Corporation. And so we'll talk about that later, but it's good to know those three bodies are the ones that enforce the provisions of ERISA. And so ERISA sets standards for most employer and union sponsored retirement plans in private industry. Very crucial to remember this. It's for private industry. And so there are standards that are set. Also remember that in the United States, employers are not required to have retirement plans. ERISA does not state that you have to have a retirement plan. It just states standards for those that choose to have retirement plans for their employees. And so if you participate as an employee in any of these retirement plans, you have certain rights and responsibilities. Again, like it says here, it does not apply to all retirement plans. And so state, local government plans, ERISA does not apply to them. Most church plans, ERISA does not apply to them. Plans for federal government employees, ERISA does not apply to them. So again, just like it's shaded in blue, all these are for private retirement plans. It goes ahead to say if you're in a collectively bargained plan, that means there's a union in place and there's a collective bargaining agreement, the rules that apply under ERISA may be different in some cases. But anyway, that's basic introduction. Let's move in really quickly. So here, the first thing we're going to take a look at is the types of retirement plans under plans that are governed by ERISA. And if you're taking the HR certification exams, you probably already know that there are qualified plans and non-qualified plans. So basically, qualified plans are plans that have to abide by ERISA. They have to abide by ERISA provisions. Non-qualified plans do not have to abide by ERISA provisions. So that's just a basic way to understand these plans. The plans we're talking about are ERISA qualified plans. And so the first thing you want to know while preparing for your HR exams, you want to know the two major types of retirement plans. And that's the defined benefit plan and the defined contribution plan. And so we're just going to look at what that means. In a defined benefit plan, it's funded by the employer. Most of the time, it's the employer that is responsible for funding the defined benefit plan. It's also called traditional pension plans. It promises the employee a specific monthly benefit at retirement. So there's going to be a specific benefit that will be paid to that employee when they retire. And I believe that that's where the name defined benefit comes from. You can define what benefit you're going to get when you retire. And it says the plan may state this promised benefit as an exact dollar amount, for example, $100 per month at retirement. The way these benefits are calculated, it's usually a formula that has to do with salary, age, number of years that the employee has worked at that company. So your pension benefit, like it gives an example here, might be equal to 1% or more of your average salary for the last 5 years of employment times your total years of service. So it looks at your salary, your age, the number of years, and with that, there's a formula that is used to calculate how much you're going to get when you retire. So your benefits are defined. You know the specific monthly benefits you're going to get when you retire, and it's funded by the employer. So that's the defined benefit plan. Now for the defined contribution plan, which is the most popular that most people have, here it's what is defined is the contributions that are made into the plan. That is what is known. That is what is clearly stated. You know the contributions being made into the plan, but it does not promise you a specific benefit at retirement. So instead, what you have with a defined contribution plan, you and your employer, they contribute money to your own individual account in the plan. So with the defined contribution, each employee has their own individual account in that plan. And it's clear to you, you know exactly what contributions you are making, but you do not know what specific benefit you're going to get when you retire. And in this case, like it states here, you're responsible for choosing how those contributions are invested, deciding how much to contribute from your paycheck through pre-tax deductions. Employers may decide to add to your accounts. They may match a certain percentage. They may say if you pay 6% into your defined contribution plan, the employer then pays 50% of that. So that's an example. And then it clearly states here the value of your account depends on how much is contributed and how well the investments perform. So unlike the defined benefit plan where it's the employer who is funding that plan and using the formulas to decide how much you're going to get for your benefit when you retire, here it's more of you contributing to your plan. You have your own plan, your own account in the plan, and you also contribute to that. And then your employer can choose or not choose to contribute to your plan. At retirement, you receive the balance in your account, which will reflect the contributions that has been made, your contributions, and if your employer chose to contribute as well, investment gains or losses, and any fees that are charged against your account. So that's basically what you get at retirement. So when you retire, all your contributions, the investments, if there were gains or losses, fees that were charged, all that would impact how much you get when you retire. But with defined contribution, you know what you're contributing right now, but you do not know right now what you're going to get when you retire. All right, so the most popular defined contribution plan is the 401k. Most people have this from their employer. There are 4 types of 401k: the traditional 401k, safe harbor 401k, simple 401k, automatic enrollment 401k plans, simple IRA, SEP, employee stock ownership plans, ESOP, profit sharing plans. These are all examples of defined contribution plans. And when we get to the end, we'll talk about a few of them, try to explain what those are. But it's key for you to remember what we've already talked about, that The employer is the one who can choose whether they want to have a retirement plan for their employees or not. Federal law does not require employers to offer or to continue to offer a retirement plan. So they have a choice whether they want to have a retirement plan, but if they choose to have a retirement plan and they are in private industry and it's a qualified plan, then ERISA would apply to those plans. Now, like it says here in number 2, the PBGC, which we already said is one of the bodies that enforces ERISA provisions. We said there are 3 bodies that enforce ERISA provisions. And just to repeat again, we talked about the DOL's Employee Benefit Security Administration. We talked about the IRS, and then also the Pension Benefit Guaranty Corporation. And so this is what the PBGC does. It guarantees payment of certain retirement benefits for participants in most private defined benefit plans. So what happens is, if the plan is not able to pay, maybe for some reason they're not able to pay the retirement benefit that has been promised to employees, then the PBGC would do that. But that's only for private defined benefit plans. It does not apply to defined contribution plans. PBGC only guarantees payment of certain retirement benefits for participants in most private defined benefit plans if the plan is terminated without enough money to pay all of the promised benefits. So some plans go defunct, some of them they're not able to pay that money, they have liquidity issues. If it's a defined benefit plan, then the PBGC guarantees payment of those retirement benefits. Like it says here, the government does not guarantee benefit payments for defined contribution plans. Now you have some hybrid plans. Cash balance plans contains features of both the defined benefit plan and the defined contribution plan. So what happens is, for your exams, I want you to see the cash balance plan as mainly a defined benefit plan. So that's one example of a defined benefit plan I want you to keep in mind. And also some questions, rather than stating defined benefit, we just say traditional pension plans, because it's traditional because that's what obtained before. So before, you had a lot of defined benefit plans, but many employers were not able to pay. Remember, it's funded by the employer. Many employers were not able to pay, and so most plans have been changed to defined contribution plans. So when you see a question that talks about traditional pension plans, I want you to think of a defined benefit plan. And if you're thinking of an example of a defined benefit plan, I want you to think of the cash balance plan. Even though the cash balance plan does have some features of the defined contribution plan, for this exams that you're taking, I want you to think of a cash balance plan as one example of a defined benefit plan. All right, so we're going to move very quickly. This table, I think, is very beneficial for you. So characteristics of defined benefit and defined contribution plans. And so here, we're going to look at what are the differences. And for the defined benefit plan, just like you can see here, employer contributions. It's employer funded. So for the defined benefit plan, most of them are funded by the employer. And so federal rules will state the amounts that employers must contribute to those plans to ensure that the plans have enough money to pay the benefits when they are due. Remember, for the defined benefit plan, you have a defined benefit as an employer that you've already stated you're going to pay these employees when they retire. So there are rules to say that you must have this amount of money, to be able to meet up with that requirement. There are penalties for failing to meet this requirement. Now, for the defined contribution plan, like we already said, there is no requirement that the employer contributes to this plan, except in the simple or safe harbor 401ks, money purchase plans, simple IRAs, SEPs. But generally, for defined contribution plans, the employer is not required to contribute. The employer may choose to contribute, but is not required to. The employer may have to contribute in certain automatic enrollment 401k plans. The employer may choose to match a portion of the employee's contributions or to contribute without employee contributions. In some plans, employer contributions may be in the form of employer stock. So just like when we talked about the ESOP, employee stock ownership plans, that's an example of that. All right, employee contributions, when it comes to defined benefit, which is this line, with employee contributions, employees do not generally contribute to these plans. You might have variations here and there, but for your exam, employees do not generally contribute to defined benefit plans. For defined contribution plans, it is required. Many plans require the employee to contribute in order for that account to be established. All right, how are the investments managed? So usually you have plan officials that would manage that investment. In DB, which is defined benefit, employers responsible for ensuring that the amount it has put in plus investment earnings will be enough to pay the promised benefit. When it comes to DC, the defined contribution, the employee is responsible for managing the investment of the account they choose from investment options offered by the plan. In some plans, you have plan officials that are responsible for investing all the plan assets. All right, for amount of benefits paid upon retirement. So remember, with a defined benefit, you already have a promised benefit that is based on a formula which we already talked about, the employee's age, the years they've worked, and the salary. So a combination of that, that's how you get that promised benefit. With the DC, defined contribution, the benefit depends on the contribution made by the employee and or the employer. The employer can choose to contribute, performance of the account's investment, and the fees that are charged to that account. Now, types of retirement benefit payments. So traditionally, again, remember, you might see traditional pension plans in a question. I want you to think of those as defined benefit plans. So traditionally, these plans pay the retiree monthly annuity payments that continue for life. When it comes to defined benefit, there might be other payment options. When it comes to the defined contribution, the retiree may transfer the account balance into an individual retirement account, which is an IRA, from which the retiree withdraws money or may receive it as a lump sum payment. So lump sum payment means you receive everything all at once. Some plans could also offer monthly payments through an annuity. So those are the types of retirement benefit payments for the two of those. All right, guarantee of benefits. We already said if it's a defined benefit plan, the federal government, through the PBGC, Pension Benefit Guaranty Corporation, will guarantee some amount of benefits. If the plan is not able to pay, when it comes to a defined benefit, the PBGC guarantees some amount of benefit. When it comes to the DC, defined contribution plan, there is no federal guarantee of benefits. Now, if you decide to leave the company before the retirement age, if an employee leaves after vesting, and we're going to talk about vesting, but vesting just means when you now have non-forfeitable rights to the money in your pension plan. So, and this really has to do with the employer's contributions. Now, in a DB, the defined benefit, if the employee leaves after vesting in a benefit, but before the plan's retirement age, the benefit generally would stay with the plan until the employee files a claim for it at retirement. So it's still going to be with that employer until the employee needs to make sure they're updating their information. The ex-employee, in this instance, needs to make sure they're updating their information so they can file a claim for that at retirement. And like it says, some defined benefit plans would offer early retirement options. Now, if it's a DC, defined contribution, and you would see that with defined contributions, it's more individualistic. You determine, the contributions you make. You can transfer the account balance to an individual retirement account. or in some cases, another employer plan. If you leave this employer, go to another employer, you can transfer the account balance to that new employer's plan. And then it continues to grow there based on investment and all that. The employee also may take the balance out of the plan, but if you take money out of the plan before retirement, there are taxes, there are penalties for doing so. Plans may cash out small accounts. All right, so I hope now it's clear the difference between a defined benefit plan and a defined contribution plan. All right, so I'm just going to pick out from this the things that are relevant for the exams. So I might skip some information. But now this has to do with earning retirement benefits. So once you know your employer does offer a retirement plan, remember there is no federal law that requires an employer to have a retirement plan. It's a choice they make, and because they choose to do so, if they choose to do so, then they have to abide by ERISA standards and provisions. So you then need to find out, when can you participate in the plan? When can you begin to get the benefits? You'll find this information in what is called a summary plan description, and we'll talk about that later. And it also says your plan may require you to work for the company for a period of time. That in addition, there typically is a time frame to begin to accumulate benefits and earn the right to them. That's vesting again. We're going to talk about vesting in more details as we go. All right, who can participate in your employer's retirement plan? Now, mainly if you're a full-time employee, you should be able to. But federal law, this is what federal law says, allows employers to include certain group of employees and exclude others from retirement plan. So your employer may sponsor one plan for salaried employees and another for union employees. Part-time employees may be eligible if they work at least 1,000 hours per year, which is roughly about 20 hours per week. So if you work part-time, you have to find out if you're covered. When can you begin to participate in the retirement plan? So once you know you're covered, you need to find out when you can begin to participate. Again, you'll find this information in the summary plan description. So this is a key document, but we'll talk about that more. So federal law, again, has minimum requirements for when employees can begin to participate, but the plan may decide to be more generous, but they cannot do less than what federal law states. So here you have a plan may require an employee to be at least 21 years old and to have a year of service with the company before the employee can begin to participate in that plan. And this is usually a question for the PHR, SPHR. You could also find this with SHRM questions as well. What you have here stated very clearly, I really want you guys to remember, a plan may require an employee to be at least 21 years old. This is the federal minimum requirement, and to have a year of service with the company before the employee can participate in a plan. So if you see questions on when can an employee, begin to participate, 21 years old and a year of service. Some questions will say 12 months. Plans may allow employees to begin to participate before that or before completing 1 year of service. Like we said before, the plan could be more generous, but it could not be less than what federal law requires. So it says here again, for administrative reasons, your participation may be delayed up to 6 months after you meet this age and service criteria or until the start of the next plan year, whichever is sooner. But that key information is what I want you guys to remember. 21 years old and having a year of service with the company. That's when you generally begin to participate in a retirement plan. All right, moving on quickly. It says here that employers may require additional years of service in some circumstances. If your plan allows you to vest immediately upon participating in the plan, so you have immediate vesting, it may require that you work for the company for 2 years before you can participate in the plan. All right, so I think that's about it for this. Federal law also imposes other participation rules. If you were an older worker when you were hired, you cannot be excluded from participating in this plan just because you're close to retirement age. So things like that. And I think we're just going to move real quick to the things that you will need to know for your exams. When do you begin to accumulate benefits? So once you begin to participate, you need to understand how you accrue benefits. If it's a defined benefit plan, it will often count your years of service to determine whether you've earned a benefit, calculate how much you would receive, things like that. If it's a defined contribution plan, your benefit accrual is the contributions that are made, earnings that have accumulated in your 401k from investments, things like that, minus any fees that you'll be charged. All right, so can a plan reduce promised benefits? Defined benefit plans, they can change the rate at which you earn future benefits, but they cannot reduce the amount of benefits you have already accumulated. So they could decide to maybe reduce future benefits from maybe $5 to $4 per month, but that which you have already accumulated, they cannot reduce that. Now it says here that if a company terminates a defined benefit plan because they do not have enough funding to pay all of the promised benefits, the PBGC will pay plan participants and beneficiaries some retirement benefits, but it will be possibly less than the promised benefits. Now, when it comes to defined contribution, just like we said, the employer can change the amount of employer contributions in the future. The employer may also stop contributing for a few years or indefinitely, depending on the plan terms. An employer can also terminate a defined benefit or defined contribution plan, but they cannot reduce the benefit that you have already accrued. Again, retirement benefits is not legally required. Do you see what I mean? It's not something that the government requires, the federal government requires private employers to have. So they can choose to terminate it, but they cannot reduce the benefits that you have already accrued. All right, this is key for this exam, vesting. How soon do you have a right to your accumulated retirement benefits? When it comes to the employee contributions, you immediately vest in your own contributions and the earnings on them. So that means your own contributions into the plan, you have 100% rights to those. So you've earned the right to this money without the risk of forfeiting them because it's your own money. However, there are restrictions on taking them out of the plan, penalties if you take it out before the age at which you should or the age of retirement. But your own contributions, you immediately vest on those. The contributions that you now need to know whether you have a risk of forfeiting them or not, those are the contributions from your employer. Okay, so the next paragraph states that you do not necessarily have an immediate right to any contributions made by your employer. And so federal law, again, has maximum number of years that a company can require employees to work to earn the vested right to all or some of these benefits. So whenever you have questions about do I stand a risk of losing this money in my pension plan, it mainly has to do with the employer contributions. And again, it's different the way the number of years that it's required. It's different for defined benefit plans from defined contribution plans. So for defined benefit plan, the employer can require that employees, so they could choose two ways of vesting. It could either be a cliff vesting or it could be a graduated vesting. In some questions, you might see graded vesting. It means the same thing as graduated vesting. So with cliff vesting, when it comes to defined benefit plan, the employer can require that the employees should have 5 years of service in order to become 100% vested in the employer-funded benefits. Again, employer-funded benefits, and that's called cliff vesting. So you have to do a total of 5 years of service, and then you become 100% vested, and that's what defined benefit plan. But in cliff vesting, if you did 3 years, 2 years, and you've not completed that 5 years, you're not going to be vested at all in your employer's contributions. So that's for cliff vesting. But for defined benefit, when it comes to a graduated vesting, which is this, just put that in blue real quick. So when it comes to a defined benefit plan, the other type of vesting is a graduated vesting schedule. And in this schedule, like you see here, it says it requires an employee to work 7 years in order to be 100% vested, but provides at least 20% vesting after 3 years. So with graduated vesting, once you've worked for 3 years, remember again, this is the defined benefit plan. Once you've worked for 3 years, you get 20% in your employer-funded benefits, then 40% after you've done 4 years, 60% after you've worked there for 5 years, 80% after you've worked there for 6 years, and then once you've done 7 years, you're 100% vested. And again, that's for the defined benefit plan, which, like I said previously, is very rare these days. Most companies offer defined contribution plans. Again, the plans may decide to be more generous, but they cannot do less than what federal law requires. All right, so unlike most defined benefit plans, in a cash balance plan, employees vest in employer contributions after 3 years. So remember, I said a cash balance plan, I want you to think of it as a defined benefit plan. And so when it comes to cash balance plan, the vesting is after 3 years, not 5 years, for the cliff vesting, like we talked about. Now, moving on to the defined contribution plan, how does it vest? When do employees have rights, non-forfeitable rights to their employer contributions? And so, again, you're always 100% vested in your own contributions and any subsequent earnings from your contributions. But when it comes to that which your employer puts in, the money your employer puts into your pension plan, it's different. So your employer, again, may use a cliff vesting, which is where you have to do a complete number of years, and then you're 100% vested. So here, the employees are 100% vested after 3 years of service. We said with defined benefit plan, after 5 years of service with cliff vesting, then they're 100% vested. But with defined contribution plans, it's after 3 years of service with cliff vesting. And then with the graduated vesting schedule, just right here, I'm going to highlight that real quick. When it comes to defined contribution, under the graduated vesting schedule, an employee must be at least 20% vested after 2 years, 40% after 3 years, 60% after 4 years, 80% after 5 years, and 100% after 6 years. So you see, with the defined benefit plan, you start getting the 20% after that employee has done 3 years, right? And then all the way to 7 years, then you get 100%. But with a defined contribution, the employee, under the graduated vesting schedule, the employee gets 20% vested after 2 years. So that's another difference with the defined benefit plan and the defined contribution plan. I'm just going to move real quick to the table so you can see that. But before I go, I'll just talk about this real quick. Okay, so when it comes to USERRA, and you might find questions on USERRA in your exams, Reserve, National Guard units, call to active duty, the Uniform Service Employment and Reemployment Rights Act requires that the period of military duty be counted as covered service with the employer for eligibility, vesting, and benefit accrual purposes. So with USERRA, even if that employee leaves for military duty, you still need to count that period as if they were still employed, as if they were actually coming to work every day. So returning service members are treated as if they had been continuously employed, regardless of the type of retirement plan that the employer has adopted. So you cannot deduct the time that they went for military duty away from their number of years of service. You have to take those that period of time that they went for military duty as though they had been continuously employed. All right, so just looking real quick at the table that we have here. All right, so table 2, which is this table, it shows the current vesting schedule for employer matching 401k plan contribution. So for defined contribution plans, this is the table you should know or remember. Makes it kind of easier. So here we already see if it's graduated vesting, and this again has to do with employer contributions. If it's graduated vesting, once the person does 2 years, they get 20% non-forfeitable percentage. 3 years, 40%, 4 years, 60%, 5 years, 80%. By the time they've done 6 years of service, they should be 100% non-forfeitable percentage in their employer contribution. So regardless of whether they remain employed with that company or not, they are going to have 100% of that employer's contribution. Now, if the employer chooses to do the cliff vesting and it's a defined contribution, then anything less than 3 years of service, they are 0% vested. But once they hit 3 years of service, they are 100% vested. And that's for defined contribution. And so real quick, we're going to look at table 3 is for defined benefit plans. All right. It says if your plan is top heavy, table 2 applies. And top heavy just means, we could look at this real quick from the IRS website. Top heavy just means that the total value, just look right here, the total value of the plan accounts of key employees is more than 60% of the total value of the plan assets. So it means that key employees, which are usually like senior executives, their value in that plan is 60% or more. And so that's basically what top heavy means. All right, but staying here where you see table 3, this has to do with defined benefit. Before it applied to contributions, but not anymore. That's why you see it ends at 2002, the year 2002. But right now, this is what applies for defined benefit plans alone. So here with graduated vesting, they have to do 3 years of service, and then they get 20% non-forfeitable percentage. 4 years of service, 40% non-forfeitable percentage. 5 years of service, 60% non-forfeitable percentage. So it adds on 20% as the years go. And then by the time that employee gets to 7 years of service, they have 100% non-forfeitable percentage. And that's for the graduated vesting or graded vesting. If it's a cliff vesting for the defined benefit plan, anything less than 5 years of service will be 0%, but 5 years of service or more means they're already 100% vested. All right, you don't have to bother about the 19, any of the other tables. We're just going to move real quick to the things that will help you pass your exams. All right, so plan information that you have to know. Usually you have a plan administrator, and like it says here, that's the person who is in charge of running the plan. You have some documents that have to do with retirement plans, and like you probably already know, we've talked about the salary plan description before. And this just gives you, like it says, a summary of the plan, details of the plan, the rules, and things like that. So it says defined contribution plans such as 401k plans generally must provide advance notice to employees when a blackout period occurs. And you might find questions as well on blackout periods. And this is what it means. A blackout period is when a participant's rights to direct investment, take loans, or obtain distributions is suspended for a period of at least 3 consecutive business days. Blackout periods often occur when plans change their record keepers or investment options. And one of the reasons why it's called blackout period is this. It's a policy or rule setting a time interval during which certain actions are limited or denied. It's mostly commonly used to prevent company insiders from trading stock based on insider knowledge. So that's why it's kind of called blackout. So the ability of that participant to be able to direct investment, take loans, or things like that is suspended for that period. All right. Okay. Let's look real quick on this table that explains better the key information your plan administrator must provide automatically. You have the SPD, Summary Plan Description. Again, it gives you a summary version of the plan, other important plan information. When should you get this? Within 90 days of becoming a participant in the plan. And you get an updated copy every 10 years. 5 years if the plan has been amended. So if a change happens to the plan, you get an updated copy every 5 years. But if no changes happened, then every 10 years you get an updated copy. All right, then you have automatic enrollment notice. Here it gives you a description of automatic enrollment process. So if you're going to get enrolled automatically, you're going to have all that information here. You have this 30 days before you're eligible to participate, at least 30 days before the beginning of each subsequent plan year. Then you have the individual benefit statement, which is a statement providing information about your account balance for that individual, your vested benefits. And you get this at least quarterly for participant directed defined contribution plans, annually for non-participant directed defined contribution plans, and then at least every 3 years for defined benefit plans. Annual funding notice. With this, you have basic information about the status, financial condition of the defined benefit pension plan, how it's being funded, the percentage, the assets, the liabilities, things like that. This has to do with defined benefit plans. And you see that it talks about a description of the benefits guaranteed by the PBGC. And you get this generally within 120 days of the end of the plan year. All right, plan and investment information for participant-directed plans. You don't need to bother too much about this for the PHR, SPHR, but you should know the SMM, Summary of Material Modification. So if a modification happens, a significant plan change or changes in the information required to be in the SPD, that's when you get the SMM. So you get this within 7 months of the end of the plan year in which the changes were made. Then you have the Summary Annual Report, SAR, and it gives you a summary of the financial information the plan would file on its Form 550 Annual Return Report. We're going to talk about the Form 5500 as we go. You should have the SAR within 9 months after the end of the plan year or 2 months after the annual report filing deadline. And I think that's the major information you should know. Again, I'm just going to talk about the blackout because I have sent a couple of questions talking about blackouts as well. So it's notice of a period of more than 3 consecutive business days where there's a temporary suspension, limitation, or restriction on directing or diversifying plan assets. Applies to most 401k or other individual account plans. Generally, you have a notice at least 30 days before the blackout date. All right, that's all I think we need to know for that. So just remember, when it comes to the SPD, you should have that if there's no change that has happened, just like we talked about here. If no changes happen, so you have that within 90 days when you become a participant, and then if no change happens, you have an updated copy every 10 years. But if the plan has been amended, then you get an updated copy every 5 years, the next 5 years. All right. So plan documents, I think we already kind of talked about that. But this is the annual report, the Form 5500. And this is what the company or the plan administrator would file to the DOL, to IRS, and to the PBGC. So it's done online. And it's financial information about the plan that most plans must file with the government within 7 months of the end of the plan year. So I have sent some questions that would ask, when should this be filed? When should the Form 5500 be filed? And that's within 7 months of the end of the plan year. So when can you begin to receive retirement benefits? And like it states clearly here, under federal law, your plan must allow you to begin receiving benefits the later of reaching age 65, or the age your plan considers to be normal retirement age, or 10 years of service, or terminating your service with the employer. Now, when it comes to, this is also key. When it comes to 401k plans, it often allows you to receive your account balance when you leave your job. 401k plans may also allow for distributions. That means you're taking money out for retirement income. For distributions while still employed if you have reached the age of 59 and a half. So usually this is the age that most people take out money from their 401k without having to pay any penalties or things like that. For profit sharing plans, they can permit you to receive your vested benefit after a specific number of years or whenever you leave your job. But key thing to remember is this 49 and a half. This is usually the age when most people can take out money from their 401k plans and they do not have to face penalties for doing that. And so just like you see here, you may owe current income taxes and possibly tax penalties on your distribution if you take money out before your age. Now, if you're in a defined benefit plan other than a cash balance plan, you most likely will have to leave those benefits with a retirement plan until you're eligible to receive them. So that's why I said earlier that you will have to update your personal information with the plan administrator, because you're no longer working there, but you still have your retirement benefits there, and you're not going to get them till you retire. So you need to update your personal information, if you change your address, things like that. But if you're in a cash balance plan, which is a type of defined benefit plan that also has individual retirement accounts, so you probably will have the option to transfer at least a portion of your account balance to an individual retirement account or a new employer's plan. With the cash balance plan, it's almost like it's a defined benefit plan, but each individual has their own account. So with that, you should be able to transfer that money to an IRA or to a new employer's plan. If you are in a defined contribution plan, which we popularly know as 401k, and you leave your employer before retirement age, in most cases, you'll be able to transfer your account balance out of your employer's plan. All right, another place you might find questions for the HR certification exams is places like plan fiduciaries. Who is a plan fiduciary? Things like that. Well, in every retirement plan, there are individuals, people who are to use prudence, judgment, discretion in administering and managing the plan, or who have the power to actually control the plan's assets. And this is where sometimes HR comes in. These individuals or groups are called plan fiduciaries. So it's based on the function that the person performs for the plan, not just their title. Now, does your plan have to identify those responsible for operating the plan? Well, the plan must name at least one fiduciary in the written plan document. And so fiduciaries, they have that responsibility to make sure that the plan is being handled with prudence, discretion, the best judgment they can. For some plans, it may be that it's the administrative committee or the company's board of directors that are the fiduciaries. For some, they identify someone by name. Usually, a plan's fiduciaries will include the trustee, investment managers, and the plan administrator. So the plan administrator is usually the key person to ask questions when you have any questions about your plan. Now, the responsibilities of the plan fiduciaries, very key important responsibilities. They must make sure that they are acting solely in the interest of plan participants and their beneficiaries with the exclusive purpose of providing benefits to them. So you cannot have situations of conflict of interest, doing things that benefit the fiduciary personally. You cannot have that happening. They also must make sure they are carrying out their duties with skill, prudence, and diligence. They must follow the plan documents unless it's inconsistent with ERISA, diversifying plan investments, paying only reasonable expenses of administering the plan, and investing its assets. They have to avoid conflict of interest. They're also responsible for selecting the investment providers, investment options, monitoring performance, and things like that. So they do have a heavy or very important responsibility, and they must make sure that they are seen to be acting in a very prudent manner above board. Now, like it says here, um, Department of Labor rules provide guidance to make sure participants have sufficient information on their investment options so they can make informed decisions. But all right, this is also another information that is key. When does the employer need to deposit employee contributions in the plan? And you might find questions on this as well. So if you as an employee, you're contributing to your retirement plan, that most likely means it's a defined contribution plan. And so when deductions are taken from your paycheck, the employer must follow certain rules to make sure that it deposits the contributions in a timely manner. And the law says that that employee must deposit those contributions as soon as it's reasonably possible, separate them from the company assets, but no later than 15th business day of the month following the payday. So no later than the 5th, let me just put this in blue, no later than the 15th business day of the month following the payday. And so if it's a small plan where you have fewer than 100 participants, salary reduction contributions deposited with the plan no later than the 7th business day following withholding by the employer will be considered contributed in compliance with the law. In the annual report, the Form 5500, the plan administrator must also include information on whether deposits or contributions were made on a timely manner. But the key information that you need to remember is that the employee must deposit participant contributions as soon as is reasonably possible, but no later than 15th business day of the month following the payday. Now, in some instances, a plan can be terminated. Remember, we said employers are not required to offer retirement plans, and so they can modify plans, they can terminate plans as well. Now, when a plan is terminated, you do have the federal law, ERISA, that provides some measures to protect employees. When a plan is terminated, the current employees must become 100% vested in their accrued benefits. So even if they've not, been fully vested, they're still on a vesting schedule. Once the plan becomes terminated, the employees must become 100% vested in those accrued benefits. Now, also, we already talked about the PBGC, whereby it guarantees most private defined benefit plans. So for terminated defined benefit plans that do not have enough money to pay the benefits, the PBGC will guarantee the payment of those vested pension benefits up to the limit set by the law. Now, if it's a defined contribution plan, which is not guaranteed by the PBGC, what you have in that situation is the plan fiduciaries and trustees, they maintain the plan until they terminate it and then pay out the assets. So sometimes you have, if your employer goes bankrupt, What usually happens is your retirement assets should not be at risk because the law requires that retirement plans um, fund promised benefits adequately. So if you've promised to put this money in as an employer, you should be putting that in and keep plan assets separate from the employer's business assets. So the plan assets or the plan money should be separate from the business money of that employer, from what that employer uses as their operating expenses. All right, finally, talking about retirement plans for the PHR, SPHR, SHRM exams. Just want to take a quick look at those terms. And you have the 401k plan where it is said that's a defined contribution plan. The employer can contribute from their paycheck before taxes are taken out. Contributions go into that account. The employee will choose, their investment options. Um, the employer also has a choice on whether they're going to match the employee's contributions up to a certain percentage, or the employer may choose not to at all. With automatic enrollment, employers automatically enroll employees into a plan, just like you have, such as a 401k or simple IRA plan. Now, with the cash balance plan, where it said that it's a type of defined benefit plan, it does have some elements of defined contribution plans because the benefit amount is computed based on a formula using contribution, earning credits, and each participant kind of has a hypothetical account. So it's almost like each participant has their own hypothetical individual account. So if you see questions that talk about cash balance plan, I want you to think of cash balance plans as defined benefit plans. All right, defined benefit plans, also known as a traditional pension plan. Some questions will not say defined benefit plan. It will just state traditional pension plans. So in this type of plans, the participant is promised a specified monthly benefit at retirement. It's usually based on a formula on salary, age, number of years that has been worked for that employer. Then you have the defined contribution plan. This is where the employee or the employer could choose to, but the employee contributes to the employee's individual plan account. And then we already talked about ERISA. This is the federal law that sets standards for protection of voluntarily established private sector retirement plans. Now, ERISA requires plans to provide plan information to participants. So we already talked about most of this plan information, SPD, summary plan description, SMM, things like that. Sets minimum standards for participation, vesting, we talked about vesting as well, benefit accrual, and funding. It provides fiduciary responsibilities for those who manage and control assets. A fiduciary must be prudent, use discretion, use very good judgment in how they manage the plan assets. Requires plans to establish a claims and appeals process for participants to get benefits from their plans. It gives participants the right to sue for benefits and breaches of fiduciary duty. If a defined benefit plan is terminated, it guarantees payment of certain benefits through a federally chartered corporation known as the Pension Benefit Guaranty Corporation. That's the PBGC. Now, for employee stock ownership plans, it's a type of defined contribution plan that is invested primarily in employer stock. We have the individual benefit statement, provides information for an individual that participant's retirement benefits. Individual retirement account, this is an individual account for that employer, for that person, sets it up with a financial institution. It could be a bank, it could be a mutual fund company. Money purchase plan, it requires annual contributions from the employer to individual accounts is subject to other rules. The money purchase plan is a defined contribution plan. Multi-employer plan, this is sponsored by several employers under collective bargaining agreements. They meet certain other requirements as well. And then if a participant changes jobs from one sponsoring employer to another, that employee remains in the same plan. Plan administrator, the person identified, we already said that's the one who has responsibility for running the plan. It could be the employer, it could be a company executive, it could be HR. The plan document, it's the written document under which the plan is established, under which the plan is established and operated. Then you have the plan fiduciary. This is anyone who exercises discretionary authority or discretionary control over management or administration of the plan, exercises any authority or control over management or disposition of plan assets, or gives investment advice about plan assets for a fee or other compensation. So the plan fiduciary has authority, control over the assets, and has a huge responsibility to the people, who are the participants in that plan. The plan trustee is the one who has exclusive authority, discretion to manage and control the assets of the plan. The plan year, it's a 12-month period, not necessarily January to December, but it's a 12-month period designated by the retirement plan for which they calculate vesting, distributions, and things like that. So it could be the calendar year, or it could be an alternative period. So for example here, July 1st to June 30th. You have the profit sharing plan, allows employers each year to determine how much they want to contribute to the plan out of profits in cash or employer stock. It's also a defined contribution plan. Then rollover, this occurs when a participant leaves an employer and directs the defined contribution plan to transfer the money in their account to a new plan, maybe a new employer plan, or it could be their own individual retirement account. You have the Safe Harbor 401k. It's similar to the traditional 401k, but with this, the employer is required to make contributions for each employee. So normally, the employer is not required to make any contributions in a traditional 401k, but with the Safe Harbor 401k, the employer is required to make contributions for each employee. The employer contributions are immediately 100% vested. Basically, this is good because it eases administrative burdens on the employer, eliminates some of the complex tax rules that 401k plans have to go through. All right, we have the savings incentive match plan for employees of small employers. So this is for businesses that have 100 or fewer employees, less than 100 employees. They can also offer retirement benefits through employee salary reductions, matching contributions. So it's either a simple IRA or a simple 401k. It has fewer administrative burdens because employees will own their own IRA when it comes to the simple IRA, and the bank or financial institution receiving the money will do most of the paperwork. One of the key things to remember though is employer contributions are immediately 100% vested in both. All right. SEP, the Simplified Employee Pension Plan, a plan in which the employer would make contributions on a tax-favored basis to employee-owned individual retirement accounts. If certain conditions are met, the employer would not be subject to the reporting and disclosure requirements of most retirement plans. Under the SEP, you have an IRA, individual retirement account, which is set up for or by an employee to accept the employer's contributions. Then the SPD, we already talked about that before. It's a document provided by the plan administrator to the participants, tells you when employees can begin to participate, how service and benefits are calculated, when benefits become vested, when payments and how payments will be received, how to file a claim for benefits. We already talked about vested benefits, those benefits that the individual has earned a right to receive and that cannot be forfeited. So it's benefits from the employer, that the individual has done the years of service and they now have a right to receive those. They will not forfeit those benefits even if they leave that employer. Years of service, the time an individual has worked in that job covered by the plan.